Welcome to Money Wire. I'm Matt McCall. Thanks for joining me today. It is Tuesday, September 15th. We got a big show ahead. We're going to be talking about the tech pullback again. We need to continue to talk about that. People are freaking out for the wrong reasons. We're going to talk about Apple. It's a big meeting it's having today. What this means for the stock, what to look for. Is it a buy now, hold, sell? What should you do with your Apple stock? And then finally, IPOs, SPACs, and your questions all coming up right now on Moneyline.
The buck starts here. Moneyline with Matt McCall.
All right, folks, once again, I am Matt McCall, and thanks for joining me today for Moneyline. As I mentioned, it is Tuesday, September 15th, 2020. Time is flying by when you're having fun. But we got a pretty big show coming up for you here today. And I got a busy day, so I got to make this fast, even though I probably will keep talking forever. We have our special monthly webinar we do for our VIP subscribers. We talk about stocks, ideas, and share our thoughts in the market. It's basically like this podcast, but on steroids with real actionable ideas. Keep in mind here, the stocks that I mentioned here, I could own or not own. I try to disclose most. Our subscribers could have them in a portfolio. I could have them for my clients at Penn Financial Group. It could be like that. So these are not real recommendations here. This is me giving you just my views on this. And you have to do your own due diligence at the end of the day and decide what you want to do, just to get that out there. I should say that every time, but I assume that's implied. But you can never assume anything these days. So let's talk about the pullback here a little bit. We have the markets bouncing the last 2 days. We did have the NASDAQ pull back about 10%, which puts it into correction territory. So that did happen in the last couple of weeks. It came right down to the 50-day moving average, which is a nice support level for a short-term uptrend line. Bounced right off it. It's bouncing off it again today. We're now up about 1.25%, 138 points. And it's early on. It's only about 10 after 10 East Coast time here on Tuesday morning. So we've only been open for about 40 minutes. But we're holding on pretty strong. And we've had some good news so far this week. We had a lot of merger talks. We had Gilead buying IMMU. Stock was up 100%. What drives me nuts about that is, as many of you know, I have my watch list, and I don't have it to my other desk over there right now. But I have a piece of paper where I'm going through the charts and I write it down. This is no lie, I'm not even exaggerating. Number one on the list was IMMU that I put down last week. As I was on a little mini getaway Thursday and Friday, I wrote it down on Friday morning as a buy. And of course, over the weekend, Gilead buys it and it goes up 100% in a day. I mean, sometimes you miss them, but I'll tell you the reason I'm smiling is because it tells me whatever the hell I'm doing is working, because we're finding stocks that are going up. So we missed that one, but that means there's more to come along the way as well. I apologize. So real quick, back at the condo, as you can see, we had a bit of a COVID scare in the office. So forced to work from home the rest of the week after being in the office yesterday. So we will be back in the office next week, and I really hope to get back in our new studio that we're building out. It's going to be awesome when we're done. So hopefully we'll be back next Tuesday. But Friday, I'd expect again to be here as we are all working from home this week. We're all safe, we're all good, so don't worry about that. But we are working from home, just be precautionary. So we are here at the condo overlooking the water here in Baltimore. A beautiful day. I'm going to try to get out this afternoon for a run if I have time. But again, this market pullback to me was, it had to happen. I mean, some of the stocks were so far ahead of itself. That being said, I'm not going to look back and say I told you this was happening, because I didn't say that at all. I was bullish then, I remain bullish now. What I will say is you have to just be realistic that when stocks go up this fast, they naturally will have pullbacks. It's a term I've been using for a very long time, actually for over 20 years. I came up with it when I used to work at a firm in Boulder, Colorado. I used to call it the healthy pullback. And people would always ask me, what the hell does that mean? If a stock pulls back, it pulls back. How's it healthy? Well, there's certain times of anything, any stock, anything in life, nothing goes straight up. And I always like to think about, you think about looking at like hiking. At the time I lived in Colorado and I used to hike, and you have these 14ers, these peaks that are 14,000 feet or more. I remember the first time I did, I was in really great shape at the time. You're going up, you're flying, but as you get to 12, 5, 13, you're getting close to that, your air is a little different. So you go super fast. My guys want to get to that next stop, and you get up there, and all of a sudden it's tough to breathe. It's like breathing through a straw. But you stop, you kind of take a breath, you take a breather, and it comes back pretty quick, and then you keep going. That is the definition of an uptrend. You're going up and take this little breather. You go up, you take a little breather. Nothing goes straight up. What I'm seeing here in the NASDAQ is a bit of a breather. It got a little too high in the altitude and had to pull back and take a bit of a breather, and that's what we're seeing. Nothing's changed with these companies. Nothing at all. If anything, we're moving to a year next year, we're going to see earnings year over year look much more impressive after this year that we've gone through. We're most likely going to see some type of vaccine before the end of the year. The COVID numbers, again, I hate to get into this because people just, you hear 10 different reasons and 10 different numbers. I use Worldometers. I look at that. Maybe that's not the best website, but I trust the website, and the numbers continue to go down. I mean, it is. Here in the U.S., they continue to get better. Not every state's the same. I'm just saying the U.S. in general. So I will say this too. Driving along I-95, anybody from the Northeast, driving along there for several hours, heading to upstate New York this past Thursday and coming back Sunday, driving through Philly, see some family. I will tell you, like, things are packed, man. Things are busy. People want to get out there. And the people that I spoke to at the resort, everybody wants to get out. Everybody wants to get back to normal. We do. Don't listen to the news and a few people that want to protest and bitch and moan. People want to get back to normal, and people are happy with America. Sure, some things have to change. I agree 1,000%. But in general, people want to get back to work and support their family and go out on vacations and do fun shit. We all do. Human beings don't want to be locked in a house. It's just not what we're supposed to do. Anyway, so this pullback, bottom line, is a great buying opportunity. And I'm likely to do some buying this afternoon, tomorrow for our clients, Penn Financial, probably for myself. I'm pretty much invested though, but I have to move some money around. I think there's some great opportunity right now. We did some buying last week, and that's turning out really well. We got one of the electric vehicle companies rock and rolling again today. We had a solar company just in the last 2 weeks rock and rolling today. So I'm liking what I'm seeing here from a lot of the stocks that we have and the market in general. So I'm going to talk about Apple, then we're going to talk about IPOs, and I'm actually going to talk about what I call the J curve. This week, by the way, is one of the biggest weeks we've seen in years in IPO market. I'm going to talk about a couple of them. Everybody keeps asking about Snowflake. I'll talk about Unity Software. I'm going to talk about some of the deals going through, a couple smaller ones, and then I'm going to give you 3 IPO ideas that are meeting what I call my J curve. So I'm going to share real ideas with you here in a moment. So stay tuned, and of course take your questions at the end. So we're going to move pretty quick. But Apple has its big event today, and by the time you watch this, the news may be out. But I'm just kind of going through it anyway. Remember, Apple's a $2 trillion company now. It's a behemoth. In the event that they're looking at today, new Apple TV, they're talking about potentially coming out. I don't see that as a big thing. Their tagline though for this event is "Time flies." Put 2 and 2 together, okay, maybe it's going to be something to watch. And that's what people are leaning towards. The new Apple Watch 6. They continue to focus more and more on health every time, which I love. I can't wait for the watch that tells me every vital going on. I'll put a chip in my arm if they want to do it, to track it and send it to the doctors so I don't have to deal with anything. But they're most likely going to add the blood oxygen level, which is really a big thing concerning COVID, because the oxygen levels were something very important that people had to keep an eye on. So now adding that and a better ECG, which they do need, electrocardiogram, they do need a better one in my opinion. You'll probably see that. So I think this could be big for sales because people are getting much more health conscious, and I think this could be really a big winner for Apple going forward. I think I have the Apple 3 or something like that. I don't even use it anymore, Apple Watch 3. So I might get this, but I also may look for something a little more high-tech outside of Apple as well. Also, a new iPad Air they're looking at potentially doing with the edge-to-edge screen, so there's no border around it. Like I said, new Apple TV potentially. I don't know if that's going to happen. New software most likely for the watch and for some of the devices. Some other things they talk about, maybe over the earbuds. These are the ones that go in my ear, maybe over the earbuds. Apple One's service bundle where they service all their stuff, Apple TV Plus, everything all together. I can definitely see that coming out at some point before the end of the year, especially for the holidays. And then AirTags, these little things, they get tag things, and then your phone you'll never lose them. So I think that's something we'll see at some point too, soon. So Apple stock, just to give you an update of where we're at, a lot of people own it or want to buy it or just want a view on it. It's at $117 right now, up at 1.4% today. But it is off the high. Keep in mind, it's had a hell of a year though. Even after its pullback, year to date, it's up about 60%. But it has pulled back from the intraday high to the intraday low earlier last week, about 20% exactly almost, right off the 50-day moving average, bouncing from there. This was after the 4-for-1 split. So it's at 117, as I mentioned. I like it down here. The thing is, Apple has always been cheap because people just valued it as a less exciting tech stock. It's now not as cheap as it was, I will admit that. And you're only looking at revenue growth and earnings growth right around the same, just over 7% in the next couple of years. So you're not seeing that huge growth. However, you never know with Apple what they'll come out with to kind of change that. I have Apple for clients at Penn Financial Group, and we hold it long term. We've had it for a while, and I have no plan on selling it right now. I still think it's a core holding for many portfolios, and this pullback is a great opportunity, in my opinion, to either establish position if you don't have one yet, or looking to kind of dabble in a little bit. Yeah, it looks good here in the pullback. So that's Apple. I just want to touch on that with the event going on here today, and also the phones too, real quick. I talk about the phones and Apple's 5G phones should start rolling out by the end of the year finally. But I also believe you're going to see them have some type of foldable device. Samsung has it. Many of you know we have a portfolio, a folding phone portfolio with 4 stocks in it. It's doing really well. And really, we did a lot of deep research in January at CES out in Vegas when the conference was still going on. And man, we talked to some of the CEOs of these companies, and it's going to be big. And it's all about not necessarily the device either. It's about the people who make the screens that fold, and eventually your TV can roll up. It's amazing what's going on out there. All right, so now let's talk IPOs. This week will be the biggest week in IPOs since May of 2019 when we had Uber. 12 deals expected, $6.8 billion in deals. I mean, it's a big deal. And we're on pace if everything stays kosher. But by the end of September, this will be the biggest month for IPOs, biggest September, I should say, for IPOs since 1999. And we all know what happened in September 99. Next few months after that, the market hit a top. The difference is you're looking at the companies that are going public. I'm going to talk about a couple this week that are going public this week. It's not even comparable to the companies that were going public in September 99. Trust me. I was younger then. Yes, don't get me wrong. I was still in college, but that's when I started investing in stocks. So this is where I learned in my school of hard knocks that way. Very different companies, very different landscape today than we were in 1999. And people who use that comparison are just not using their brain. It just doesn't make sense. It's somebody trying to get a headline, trying to fearmonger, trying to just be on TV. Trust me, if you want to be on TV, just hire a PR firm. They'll put any schmuck on there. I mean, just pay your dues and get on there. I will tell you this: if you think you want to get on TV and it's going to make you millions of dollars, it doesn't. I'm not to be conceited, but I was one of the best guys on there, one of the truest, the best track record. You look at TipRanks right now. TipRanks ranks all the financial bloggers, and they don't even have our paid stuff on there. They have the non-paid stuff, and the paid stuff's much better behind our paywall. It has me ranked as number 3 blogger in the world right now. What we do and what I do, we do it because without having good stock ideas, I lose subscribers. If I don't have good stock ideas for my clients, I lose clients. If I lose subscribers and I lose clients, guess what? I don't make any money. So the only axe I have to grind here is to make people as much money as possible without taking obviously too much risk, without taking a calculated approach to the markets. And not that dwell on last Friday's podcast, but a lot of people ask why I don't own the stocks that I recommend for subscribers or that I recommend for clients at Penn Financial Group. And the reason is because I don't have to, number one, it's unethical to me and almost borderline illegal in many instances. The short sellers do it, and I think they are extremely unethical and probably illegal, even though they disclose it in fine print in the bottom. I've been going at it with Money Waters on Twitter, the firm that comes out and bashes companies. Yeah, and the guy came out and said, well, we had 8 frauds. Yeah, what about the other 100 and some companies that you tried to ruin that you didn't ruin, but you profited in a short term because you shorted them? Why don't you disclose how you shorted them, how many shares, what day, when you covered? It's all BS, folks. You know everything that we're doing here. We disclose it all. So for me, again, if you think what I'm doing, I should be owning, what the ones I recommend. One of the subscribers brought up a great point, and what I just said. It doesn't matter. If I can't make you money with my recommendations, you'll cancel, and then I have no money in my pocket. So I have to do the best. It's common sense. If you don't get it, I get it. So back to IPOs. Snowflake is the biggest one of the year so far. It's going to be about $3.1 billion. They're looking to raise. It's a cloud computing company. It's going to be the biggest software IPO ever. And the biggest since going back to VMware in 2007. So this is a big deal. They originally were going to price the stock between 75 and 85, and now looking between 100 and 110. Valuation at that is around 30.5 billion. Already a big company. It's going to trade on New York Stock Exchange under the symbol SNOW, S-N-O-W. They booked a net loss during the first 6 months of its fiscal 2020, which ended in July 31st. I don't know why these companies don't just end on June like everybody else, but their fiscal year ended July 31st. They had a net loss of 171.3 million. Same period last year, lost 177.2 million, so about the same. However, revenue rose to 242 million from 104 million. So that's really what you want to see in a company like this that is still early stage, even though it's valued at about $30 billion. It's still an early stage company. You want to see revenue increase. The bottom line doesn't mean as much to me because eventually hopefully, part of the requirements for me when I'm buying into a company that doesn't make money is what's called a path to profitability. I need to see a path to them becoming profitable. Because if they're not profitable, it's not a company I want to be in. It doesn't need to be profitable in the next couple of years, but there must be a path to get there. And along the way, revenue growing dramatically. Here, as you can see, revenue more than doubled year over year in the first 6 months of this fiscal quarter. So it is one to keep an eye on. Again, the symbol is going to be SNOW, S-N-O-W. It's going to be traded on New York Stock Exchange. All about cloud computing. And you think about it's data, cloud information, getting access from everywhere. We kind of need that right now. There's more and more data being created every day. So I love the business model. We need to see how it opens and how it trades. It may trade well into the 150s, and valuation may be at a whack at that point. So it's something to keep an eye on. Another one that's a big name out there, it's Unity Software, symbol U. This will trade on New York Stock Exchange as well. They're looking to raise up to $1.2 billion, so it's a big deal as well. That put valuation around $11 billion for the company. They brought in $541.8 million in revenue in 2019. During that time, they lost $163 million. 2018, they had revenue of $380 million, lost $131. So revenue has gone up about 160. So about 40% increased year over year, 18 and 19. Loss dropped from the loss actually increased from 131 million to 163 million. But again, that's typically normal in a company that's preparing to go public because they're spending a ton of money, expansion. So again, it's something I keep an eye on, but maker of 3D games. So this is something to keep an eye on. Epic Games is somewhat of a competitor. They're private, partly owned by Tencent Holdings, which I really like, which is one of the largest tech companies in the world, one of the largest in China. It's trading at $69 a share right now, just off an all-time high it hit last month, which we have in one of our portfolios way back for many years. So Tencent owns a bit of Epic, but Epic has much more sales here than Unity. But again, one to keep an eye on. I can't tell you if these are buy, sells, or hold at this point because they're not trading yet, and we need to see how they trade for a little while before we can consider it. Another one I caught my eye, not nearly as big, looking to raise $560 million, is Amwell. It's a telehealth company. Everybody knows how I love Teladoc and how that's been one of our core holdings for many years, and it's up over 400% since we put it in a portfolio. Teladoc's TDOC, by the way. Amwell, they are looking to list at between $14 and $16 a share. Again, raising $560 million. They're going to use those proceeds to develop the company's platform, come to develop it, invest in some AI and automation, which you really do need for telehealth. And of course, expand a company's sales force and then look for potential acquisitions. So it's covering all the gamut right there. They had a net loss of $113 million in the first 6 months of this year. The loss for the first 6 months last year, 2019, 41 million. So you're going to see again, it's increasing as they ramp this up. However, again, revenue went from 69.1 million the first 6 months of 19 to 122 million the first 6 months of this year. So up about 85, 90%. So again, you're seeing a pattern here of a lot of these IPOs, and that's typically what you're going to see, and I'm okay with that. But this is one I definitely want to keep an eye on because the future of telehealth is huge. Teledoc's the clear global leader right now, but that could change. And of course, there's a lot of market share out there. The TAM, the total addressable market, is huge for this. So it is something to keep an eye on. And one other one called Outset Medical. It's going to be symbol OM. It's a med tech company, so medical technology company. They plan to offer about 7.6 million shares between $22 and $24 a share. Looking to raise about $182 million at the top end of the range. It will list on NASDAQ, as I mentioned, under symbol of OM. Proceeds from this deal used to expand sales and support staff, research development, more working capital. A bunch of banks are behind it. Some of the big ones, BOA, Bank of America, Morgan Stanley, Goldman. But you know, they're in a rapidly growing medical tech area, which is fantastic. And what they do, it's kind of a first of a kind type thing. It's a technology used for dialysis, and that can be used at home. Basically using water at home, using just electricity in your home, you are able to do your dialysis at home. And I don't know anybody personally doing that, but obviously I know many stories about people in dialysis. I know there's too many people on it right now, unfortunately, due to our very unhealthy way that we live. You're seeing a ton of people on it. That's why you see dialysis centers all over the place. It's crazy. I mean, what a business. But if you can get this at home and not have people go to dialysis centers, especially older people that maybe not travel as well, maybe they can't drive, they need assistance. This could be a game changer, folks. Again, it hasn't started trading yet. I need to see how it trades. I need to look into a little bit more, but I just want to keep an eye on Outset Medical, symbol OM. And I love med tech, as many of you know. Our medical tech, future of healthcare portfolios are absolutely crushing the market. So, and then just to wrap up the IPO week, in the last week, believe it or not, 9 SPACs, special purpose acquisition quotes. You know what SPACs are at this point, also known as blank check companies. 9 of them went public in the last week, raising about $3.1 billion. I mean, this is so hot. It's so hot it scares the shit out of me because I hate being in something that's so hot. However, I still believe there's such great opportunity there because you can't just blindly buy a SPAC. You need to look into who's behind it, what they're going after, be patient. We've had much success in SPACs, and I think we'll have a lot of success in the years going forward because I believe it will be the new way to go public for a lot of companies. One that jumped out that was kind of interesting is one that was a SPAC that was led by a former White House advisor, Gary Cohn, which he raised $720 million in that SPAC. That's one to keep an eye on. So back to IPOs, and I told you I'd give you some ideas here. I'm not saying you don't buy these, but some ideas. And these IPOs are recent IPOs that have met my J curve. And it's tough to do J curve without showing you, but think of the letter J. And it's the best way you think of it. Typically an IPO gaps up. But then over time, it could be a couple of days, could be a couple of weeks, could be 1 or 2 months. It pulls back like this and forms a bit of a U. It pulls back, and when it starts coming up, it creates this J. When it breaks above the prior high, that's a breakout. William O'Neill at Investors Business Daily has a pattern they call a cup and handle. It's like the same U, but it goes sideways as a handle and breaks the handle. It's a breakout. Very similar. The J doesn't always have a handle; it just comes up. And a lot of times you maybe try to catch it on the way back up, but you always want to wait for the pullback because almost every IPO pulls back. If it doesn't, you missed it. It's too damn bad. But most will pull back. So I went through and I found a couple that are doing that right now, or close to it. One's called Applied Molecular Transport, AMTI. It's a clinical stage biotech, about $1 billion. So it opened up back in June. In the teens, ran up to 30, then pulled back and formed this J around 20, now breaking out and closed at the best level ever yesterday, above 30. It's down today about $30.50, down about 2% today. Again, these are not buy recommendations, but I'm just trying to show you that J. It's trying to break above that J pattern right now. But again, this company has no revenue in sight, no profitability in sight in the next couple of years, so a little bit too risky for me, but it is one that came up as far as the pattern when I did my pattern scans that I do every morning. Another one's our biotech called Repair Therapeutics, RPTX. Very similar. Opened up in the low 30s, came all the way down to the low 20s, and now we're back up to the low 30s, forming this U, this J. If it breaks above 33, 34, this looks like it could take off. This one is gene therapy for cancer treatments. Again, no path to profitability anytime soon. It has a very, very small, minimal revenue that doesn't really affect anything, about a little over $1 billion company as well. But it is one I'll keep an eye on, put on my watch list, because I like anything to do with gene therapy and cancer treatment. Again, we'll do a deeper dive, but it is one I'll keep an eye on. Another one outside of the complete realm of what I just talked about is Vroom. VRM is a symbol. Went public in June as well. Went public around 50 bucks, pulled back to 40, ran to 60, pulled back to 40, ran to 70, pulled back to 50, ran to 70, pulled back to 51 again. But you're kind of seeing it's a sloppy J curve at best. But if we start this right side up here, it's very interesting. It's an e-commerce platform for buying and selling cars. As many of you know, I just bought a car recently. But I did look at all these websites, especially Carvana, which if you look at how Carvana has done, man, I mean, it's pulled back a lot in the last 2 weeks, but it was at an all-time high 2 weeks ago. One of the better performers, when this went public back in 2017, it fell down to $8 a share, and we just hit 2 weeks ago, believe it or not, it hit 235. So $8,000 would have turned into 235 in that time frame, and that's in 3 years, folks. We're not talking big time frame. This is obviously competitor to that. So Vroom, what I like about this though, they did have sales last year about 1.19 billion, and the estimates for sales in 2024. So in 5 years, going from 1.19 billion to 8.26 billion. So it is a company I'm gonna keep an eye on. I liked Carvana much better when I was playing around with this stuff, but I will keep an eye on this company. And the last of the four that I'm gonna talk about, this was not planned either. The symbol is actually FOUR, F-O-U-R. See, sometimes I'm just funny and I'm going to try to be. It's a payment processing company, Shift4 Payments. Went public back in June, 30s, ran up to high 40s, pulled back to 30s, came up to mid 50s, pulling back. It's now sitting on its 50-day moving average of 45.34, down a few pennies today, sitting on price support around 45. I think this looks great right here. This is a payment processing company. I didn't have a chance to look at the fundamentals, but I can scan them for you really quick here. Looks like earnings last year, revenue came in at 731 million last year. By 2022, 1.35-ish. So doubling in about 3 years. That's really nice. But the forecasted annual revenue growth the next couple of years, 29.5%. That's fantastic. Forecasted annual earnings growth the next couple of years, over 131%. So let me take a look here at one more thing. I'm looking at another one of our systems we have here. Shift4 Payments real quick. And of course, somebody knocked me out of it right when I need it, but give me a second because this might help us out and look at this. But technically, it's pretty amazing. I will say that. $3.5 billion company looking to lose this year 29 cents a share. But then if we look at next year making 55, the year after that making $1.20, $1.12, doubling from 21 and 22, man. So this is one I definitely keep an eye on. Obviously in a hot sector, you're seeing bottom line grow very, very dramatically. So and at a price to sales ratio of only about 2.6, so it's not really overvalued. You know, some of these software companies have price to sales of 10, 11. One I want to keep an eye on. This is going on my watch list for sure here, and you know, this is how I come up with ideas all the time. Just looking at charts, looking at fundamentals, looking about the company. Obviously, I'll do more research into it, but this is how we come up with ideas, folks. It's not hard. It's easy, but it's so to say, it's not easy. It's simple. What I do is simple, but it's not easy to do. Staying in shape is simple. Eat well, work out every day. Is it easy? Hell no. Hell no. I don't feel like going to run later today. I'm nice and relaxed here at the condo, but I'm going to go do it. I'm going to go work out. Alrighty, so let's get close to wrapping this up, and we're going to talk about stocks, the questions that you gave me on Twitter. And again, I just do it in the morning, and I take the ones that come out first. I don't do it in any really specific order. If there's one I think that a lot of people want to know about, I will pick that one. So let's go with Workhorse. A lot of people ask me about Workhorse, WKHS. As far as Workhorse is concerned, keep in mind we recommended this at $2.74 a share. Right now it's at 25.25. Yesterday's high was 26.23. We recommend this on May 1st. So we could easily in June, July, August, September. 4.5 months, we're up over 800%. So a 9-bagger. Closing in, once you hit 900%, it's a 10-bagger. Closing in yesterday, so close to the 10-bagger, in 4.5 months. So congrats. Thank you to all our subscribers who got into it. We obviously sold a third, took a profit, sold another third, took a big profit. We're playing with house money times many times, and we're going to let this third run. I still love Workhorse here. Do you buy it here? I don't know. I mean, it could pull back to 20, which would be a 20% pullback and still look great and pull back. From day to day, it's very tough. But I will say, of the electric vehicle companies, this has held up much better than a lot of the small ones. Let's put Tesla in its own category. Outside of that, this has held up so much better. What about Nikola and KLA? Had its short report come out. The stock was at 50 just a couple days ago. Now it's at 33 and change. And you're only looking to do revenue of what, 30 million this quarter or something like that? I mean, come on. I just don't. I don't see Nikola. I think the short report they put out was garbage. But I don't like Nikola here. I'd much rather have Workhorse over Nikola here, and a couple others, as a matter of fact, which I'm not going to share because we have those for clients at Penn Financial Group or in our newsletter, or for myself, as a matter of fact. But I will talk about another one now that I don't have any exposure to right now, and that is Diamond Peak Holdings, DPHC. And this is going to be this is a SPAC that's combining with Lordstown Motors, which Workhorse actually owns a percentage of, and the Lordstown Motors is the factory, used to be a GM factory. A lot of tie-ins between GM, Workhorse, Lordstown Motors, and now you have Nikola in there because GM is now tying up with Nikola as well. So you're seeing a lot of these companies all kind of tie up. Could we eventually see all these come together as one big? Absolutely. I think we could see that at some point down the road. So Diamond Peak Holdings will be Lordstown Motors, and it's DPHC right now, the SPAC. It's up another 2.5% today, 28.68. Hit an all-time high yesterday at $30 even. Again, remember SPAC's price at 10, so this is up a lot. It's up $18.65 from that SPAC price it was in July at $10. So it's priced in quite a bit already. Like the company, but again, I still lean towards Workhorse over this one. It's one I keep an eye on though. Next one is On Semiconductor, ON. For me, this is a big play on autos. They make some semiconductors for the auto industry. It's about a $9 billion semiconductor company. It trades right now with a forward PE ratio of 16.8, so it's low. Forward price to sales of 1.6, which is fairly low. Excuse me. Earnings per share looking at about 66 cents this year, $1.31 next year, $1.87 year after. Big growth. I love this. And again, it's a semiconductor that's in an area that I really like. It's been going sideways for a while. Even though it's a $9 billion company, it's not something that a lot of people talk about. It's not a semiconductor a lot of people will talk about. But again, the earnings are really taking off. I love that. For forecasted annual earnings growth next couple of years, 99.8%. Revenue only at 7.7, but they're fine tuning that, and that's that path to profitability at the bottom. We really start taking revenue and turning into profits, and I love to see that. And again, if you're looking out at 2022 at $1.87 per share, you put a multiple of that of 30, because with that growth, you should have a multiple of 30. Let's call it 190, make it easy, 38. You're looking at what, $57 a share at 22 right now. Just for full disclosure, I do have this in one of our newsletters, early stage investment opportunities, which again, it's only $99 a year. If you're not a member yet, I don't know what the hell you're doing. Go to McCallMoneyWire.com, McCallMoneyWire.com. Check us out. There's also free articles on there as well. So that's one people were asking about. Another one is OSH, and this is actually another recent IPO as well, Oak Street Health. I don't know too much about it, to be honest with you, but I'm going to pull it up here and look at it here with you. But I did a little research before it went public. But it's a network of primary care centers for adults on Medicare. So it operates basically focuses on a network of quality care, as I say, of services. They assume full financial risk of its patients. They operate more than 50 centers across Illinois, Michigan, Indiana, Pennsylvania, Ohio, Rhode Island, North Carolina, Tennessee. Look to expand in Texas and New York soon. It is a fairly big company for a recent IPO, $9.2 billion. You look at it, it's still losing money this year, next year, and probably in 2022. Revenue growth up to $1.76 billion in 2022. It's an expensive company. So for what it does, it's expensive. I like these kind of more personalized medicine approaches, but it's one I would stay away from right now just based on pure valuations. Sticking with that, somebody asked about FBIO, which is Fortress Bio. This company's had a hell of a run as of late. FBIO at 415 today, it's down over 4%, but it just hit yesterday, best level since 2018. Still a small company, $365 million company. But what I like about this is looking to have revenue. Last year had revenue about 36 and change, 36.6 million. This year looking at 47. Next year 65. 2022 129. So you're seeing this ramp up. Earnings per share, losing money. Losing money again this year, probably about 60 cents a share. Losing money next year, about 28 cents a share. 2022, potentially making 78 cents a share. Now let me go check this out on another one of my systems because that seems quite impressive right there, especially for a company that is trading at about $4 a share. If you're suddenly making that, and again, it's less than $400 million market cap. They're looking to obviously commercialize something and gain approval. The other thing is you look at revenue going into 2024, you're looking at $251 million by that time. And if I look out to 2024 for estimates, we're looking at over $3 a share. So this all hinges on its pipeline and approvals. And if that happens, let's just do the math. And when it comes to biotechs, you need to have a 5-year time frame. It's 2024 and in 2024, so it's 4-year time frame on this one. If we hit $3 a share and it's growing like that, it probably trades at what, 30 times earnings? That's $90 a share from $4. I'm not saying that this company is a 25 bagger from here, but again, they may get zero approval and it goes bankrupt. But these are the kind of companies you want to look at, and I have no exposure to this company, but I will put on my watch list because of that. I will see in my notes here that in a prior newsletter, I did own this stock down around $3 back in 2015, 16, and sold it. So we're out of it since then. It hasn't really done much since then. It is one to keep an eye on, but this will take extreme patience, absolutely. So thanks for that question. I just want to touch on that. And then we talked about Snowflake already. And then one more topic here, and these are two SPACs that people asked about. One's Trine Acquisition, TRNE. This is going to be merging, or announced that it will be merging with a 3D printing company. And 3D printing is one of the most overlooked, high potential places in the world right now. I really love it. I really think that there's huge upside for this. Desktop Metal is the name of the company. Could value a 3D printer company around $2.5 billion. And again, remember, SPACs are $10. This is at $12.30 right now, about 2% today. So it's pricing about 23% above the normal SPAC price. Not as high as a lot of others, but it has rallied quite a bit from there. It is one I keep an eye on. I like 3D printing. I'm going to have to do some more research to see if this is a buy price here, but it is one I will definitely keep an eye on. The next one is NFIN, Netfin Acquisition Corp, another SPAC. Netfin Acquisition Corp looks like they're going to be combining with Triteris FinTech. I know nothing about this company. They're focused on global trade, basically trading of commodities and stuff. I don't know anything about it, so I'm staying away from it. I don't even want to give you an opinion, but I thought I'd mention it because it is one that's open to combining. Last but not least, I'm going to talk about Opendoor. And the reason I'm talking about Opendoor is because that was just announced this morning, symbol IPOB, B as in boy, which is Social Capital Holdings Corp 2, which is a SPAC. They announced this morning that they're going to be combining with Opendoor, which is, let's say it's a competitor to Zillow, Redfin-ish. Basically make the whole buying and selling process online. I love that idea. Valuing it about $4.5 billion, so it's valued at pretty high. Again, I need to do more research. This just came out this morning, but the SPAC is up about 18% on the news, 1541. It started moving on the news recently, but the deal came out. It's almost as if somebody knew something was going on. And then there's IPOs, which is the guy who runs these. Has been very, very successful. He was behind Virgin Galactic Space, SPCE. We all know Richard Branson's space company. So IPOC is trading at $11.85. They haven't even announced anything yet. So it's up, it's up that much already, 18% from the SPAC price, and it hasn't even announced anything yet, which is amazing. So let's keep an eye on these. Again, I'll do a little more research for you guys, get back to it. But I think we covered a ton today. We're a little longer than normal, but I think it's all right because I think there's a lot going on. Very busy week. One more thing to touch on, NVIDIA, which I do have exposure to through subscribers. Amounts a huge deal, $40 billion deal to combine with ARM. You're basically taking two of the most exciting, best semiconductor companies in the world, combining them. Long term, this is great for the company. Love NVIDIA. This has been a huge winner. I think it continues to move much higher from here. So again, if you have any questions, please let us know. Comment below. Like us, subscribe, share with your friends. We're looking to take this thing viral. I mean, I can't wait. We're getting more and more viewers, better comments. Please comment below anything you want to say. We try to get to as many questions as possible. And to our subscribers, thank you from the bottom of my heart. My clients, thank you from the bottom of my heart. Check out McCall, Free articles or newsletter services are there, starting as low as $99 a year. You can't go wrong. Again, go out there, enjoy the rest of your week. Be safe, be healthy. Go give somebody a hug, love them, and we'll be back Friday morning. And once again, I'm Matt McCall. And that's been your Moneyline.
Thanks for listening to Moneyline with Matt McCall. To find more information, head over to McCallMoneyWire.com. That's McCallMoneyWire.com.